Good morning, ladies and gentlemen. We'll just give it a couple of minutes for all participants to join in case there's any latecomers. Thank you. All right, good morning, ladies and gentlemen. We might make a start. Thank you all for joining us today. My name's Anthony Murphy. I'm one of the 4 members of the investment committee of the Lucerne Alternative Investments Fund, and we're here today joined by Ryan Sohn, portfolio manager of the Perennial Private to Public strategies. Perennial have 3 funds operating in the private to public space. We participated in Private to Public Fund No.II, both at the LAIF level, which is currently a 5 to 6% weighting in our portfolio, and also we had a number of our investors participate directly in that fundraising as well back in late 2020 it was. So really today what we thought we might start with Ryan is for Ryan to give us a bit of a background on the strategy and just a rehash for some of those today that are unfamiliar with Perennial's private to public strategy. And we'll then dive into how that strategy evolves over time in the portfolio. And I won't steal Ryan's thunder, but then he can provide a very live update on how that current portfolio is going and particularly talk to January's performance. As per usual, we like to keep this quite open and warm, like a fireside chat, so feel free to ask any questions via the Q&A function at the bottom of the screen, and we'll address those today. And if there are any additional follow-up questions, I'm sure Ryan will be happy to contact investors directly and email answers through. So we might make a start, and then Ryan, again, thanks for joining us today. And yeah, the private to public strategy, what's it all about?
Thanks, Anthony, and thanks everyone on the call for your support. We really appreciate it. I will apologise in advance if my 2 dogs decide to bark in the background. They do tend to play a bit, so if you hear a bit of a screech, that would be one of my dogs. So the private to public strategy, I'll just give you a quick sort of overview again of the core strategy of the fund, and then we'll sort of delve into how we've positioned PPP2 at the moment. So the private to public strategy is really investing in 3 buckets. So the first bucket is unlisted expansion and growth companies. Those are businesses that we think are up to 2 years out from an exit event, predominantly an IPO. And we usually like to invest in these companies through a straight equity position. We want that equity upside. And we think that they've got significant sort of upside. So 2 to 3 times is what we're looking for at a minimum. And I'll run you through some examples of those later on. The second bucket is the pre-IPO bucket. Those are positions which are sort of 3 to 12 months out from an IPO event. They're usually at the size and scale that they are ready to list today, but they could take some institutional investment on board before listing for 2 reasons. 1, it helps them to just grow that little bit faster before a listing, and 2, it de-risks that ultimate IPO event by getting some institutional support that could buy into the IPO. And then the third bucket is what we call listed placements and IPOs. So this is where we enter into the listed market either through a primary raising, whether that's an IPO or a capital raise that a listed company is doing, and we always do it at a discount to what the share price is trading at. or an IPO discount. So every time we invest, we are looking for some sort of discounted entry. And I think one of our core disciplines is valuation, and you'll sort of see that coming through. We've been really strong on using long-term historical averages as our valuation support. So we don't look at the last night's trading average on the listed market. We always use a 5 to 10 year average of what these stocks should be trading at and apply some sort of discount to that multiple. And that we think is going to play a crucial role in the fund going forward, particularly with what we've seen in the last sort of month or so with sort of the tech sell-off. So I think it's probably, this is the team. So the team at the top is dedicated to the private to public funds. Since we launched PPP2, when we launched PPP2, we added Brendan onto the team. So it was initially myself and Andrew that started the strategy, but given the opportunity set, we thought we needed a dedicated resource, so Brendan joined. Since then, we've also hired Karen Chan and James McQueen. So Karen joined us from Investec. She was head of emerging companies at Investec, which is a private company strategy. She's got excellent skills in that sector and has got quite a broad sort of connection and network base. So she's been an excellent addition. She's a portfolio manager now on the strategies and has really added a lot to the team. And then more recently, we've hired James McQueen as a dedicated resource to the team. So James, we've known for a number of years. He's actually worked in a couple of our portfolio companies as their legal counsel. So he brings that strong sort of legal execution skills. And as we found, private deal flow or private deals require, quite stringent sort of legal work to make sure we get our terms right. We want to make sure we minimize the downside and maximize the upside, which can take a lot of legal back and forth. So James is added to that team, and so we feel we've got sort of a very experienced team to continue to execute. And it's as much about getting your investments set, but then also maintaining those investments over time. So that's what we're quite focused on at the moment. The rest of the team outside of the dotted line is part of the smaller microcap team. As you can sort of tell with the three buckets, there is that sort of synergies between the listed and the unlisted world. We're sort of that bridge capital between the two. So if there's someone with expertise in the smaller microcap team, we'll often call upon them. So it's
just across the three private and public strategies, Ryan, that you're actively running. What's the total fund across those three at the moment? It's roughly 350.
Yeah, so the first private to public fund, we raised 65 million. The second private to public fund was 150. And then the third one's been 200. We think 200 is probably an optimal strategy to make sure that we can still be very nimble. In terms of the opportunity set in the private space, it exceeds that by multiples. But that number enables us to be pretty active if we need to be in pre-IPOs and listed positions, just to generate some of those early returns if required. And it's important, those three buckets, because what that provides us is that ability to layer the liquidity throughout the sort of life of the fund. So what we're aiming to achieve in the fund is a smooth return profile and avoid that J curve that's typically associated with normal private equity or very early stage investments. So if you think about that, the listed bucket, that gives us the flexibility if we see good opportunities early on to sort of participate in those and get some early returns. Obviously, the last few months have been somewhat more difficult in the listed sphere, so we haven't generated a lot of those early wins. But we've got that option if we need to be flexible. The pre-IPOs are probably the next bucket that kicks in, that we can then sort of get those in years sort of 2 to 3. We start to get returns from the pre-IPOs, and then finally the unlisted expansion and growth gives us an opportunity for the back end return. So it's a much smoother return profile. But those two buckets do take a bit longer to come through, but it sort of staggers the return profile instead of having everything weighted towards the end of the life of the fund. And this is the performance of fund number 2, and it does actually sort of play a nice sort of picture. So you can sort of see here from October through to October, that's the first year. Most of those returns were us whilst we were deploying into the pre-IPOs and into the unlisted sector, just generating some small incremental returns through listed placements and IPOs. We target sort of high single-digit returns in the first year whilst we're getting set. Remember, that's sort of a third of the portfolio pedaling pretty hard to generate that high single-digit. And then once years 2 and 3 come on, we start to see an accelerated return profile as one, pre-IPOs transition from pre-IPO to IPO and you get that uplift, or some of your unlisted positions start to materialize and you get a quite a significant uplift. So we've, as of January, I mean, these are sort of estimates. We'll reconcile them in a few days' time, but they're pretty accurate estimates, I would have thought. We had a repricing event in one of our unlisted positions, Animoca Brands, which we held at cost, and they just raised quite a large, they raised 380 million from US investors. So that was a repricing event. We did sell a little bit into that raise, just to make sure we kept the weight at sort of a good level, and also would give the opportunity for those realized gains at the end of financial year for investors. So it's a trust structure, so any net realized returns gets distributed back to investors at the end of the financial year.
Probably worth noting, I mean, for investors on the call, this is the power of a private to public strategy. You've seen the ASX 200 fall just over 6% in January. This is the type of strategy through one investment, raising capital at much higher valuation can move the portfolio markedly. You've seen it looks like the fund's going to be up circa 12% for January alone. I mean, you compare that with the sell-off in traditional equity markets. You know, that's one reason why we hold strategies like this across investor portfolios.
Yeah, it's a really important piece. We find this to be totally uncorrelated to the listed market. Obviously, we've got that small portion that's got sort of market is exposed to the market, but we can be flexible as to how we allocate the capital across the buckets. And so we actually position ourselves to be more into the private market during this period. And we, you know, the list out, I still spend sort of 25% of my time in micro and small caps, and the small odds was down close to 10% for the month versus this fund, which is up circa 10 to 12%. So it's an uncorrelated return profile. But, you know, having the 5-year closed-end funds means you can be quite patient, and then you start to get the fruits of your work as it comes through over the life of the fund, without having that sort of really volatile experience that you can often get, like we had with the listed market over the last month.
What percentage in the portfolio are you carrying at the moment that's just purely in the listed space?
Yes, I'll go through to the next slide here. This is the portfolio exposure that we had as at end of December. So you can see we only had 8% that was exposed to the listed market. We didn't participate in any placements during that period. That exposure was purely 2 of the positions that transitioned from pre to IPO small positions. So we purposely, we always felt as though the listed market was a bit topsy and valuations are a bit stretched. So we positioned ourselves to try be more exposed to the pre-IPO and unlisted, and sort of let high quality businesses mature and grow. And then when the time's appropriate, they could get a nice uplift when they list. So it's sort of a good indication of how we're seeing the market. Obviously, that 56% is higher because we've had a repricing in there. That started more at sort of 40%. It's grown because of the repricing. And then we've still got a large portion of pre-IPO. So the majority of this fund is still carried at cost, which means that a lot of those positions are doing a lot of sort of operational work behind the scenes, but are not being reflected in the unit price just yet. We spent a lot of time over the last few months speaking to all these pre-IPO and expansion companies to understand where they're at. And pleasingly, all of them are sort of at expectation, with some of them materially ahead of expectation. So we're the next few months, as we sort of go back to this slide, we should start to see some larger months come through as those positions materialize in an uncorrelated sort of way to the listed market.
I think it's also worth noting, for the audience's benefit, when Ryan's referring to holding those investments at cost, if you think about the listed space and one buys a listed equity for $1, that share price fluctuates on a daily basis. And if the value of that business was to increase to say $2, well, then your investment has doubled. But in the private space, if you own that asset at $1, even though the underlying business might be performing exceptionally well, not until there is another capital raising event at a higher or lower valuation will Perennial reprice the portfolio. So, you know, to be crass, there's no window dressing on the numbers. In fact, there's a conservative approach taken to the numbers that says we're just going to hold this at cost, even though that we know Animoco Brands, for example, has just had the re-rating. The businesses are is flying. That actual repricing does not occur until there is a new stake in the ground where investors have put in fresh capital at a higher valuation.
Yeah, it's a really important piece, and because it's a 5-year closed-end fund and it's the capital's there, there's no need for us to sort of reprice any positions unnecessarily. So we do take a conservative approach with our valuations. We hold all of them at cost of the price at which we last paid until it has to be a third-party transaction, so someone else coming in and investing in the company at the same class of shares, because that for us is third-party validation of what someone else is willing to pay. So, for example, we did a small follow-on investment into one of our companies in PPP2 at a 50% higher price than what we initially paid. The business's revenue is up 3 times. We still held that initial investment at cost, given there wasn't that third party. So it is a conservative approach, but we think it's just important for the strategy. I can see there's a question just come through there.
Does that exclude the public holdings? I think it's referring to how you hold the public holdings at cost, which obviously you don't.
No, so the public holdings are mark to market every day. So those are, and that's because there's third party validations of those every day, and we're pretty active in those positions that we can sell them if we think there's a valuation. But all the private positions whereby there's not an active market, we hold those at cost.
Thanks, Ryan.
No problem. So this is just another sort of focus as to where we invest in terms of the cycle. So if we look on the left here, we see these as more sort of concept, very early stage investments. They may not have sort of a product in market, or they've just got an early product in market. The risk is high. Obviously, if you get that right, you can get a really outsized return. But the risk is significantly high, and that's where we see what typically are called seed, pre-seed, or maybe Series A investments. Where we look to play is companies that have got a proven product in market, have got to a certain revenue scale. We say 5 million's the minimum revenue required, but if we look at our portfolio, the average revenue is closer to 20 to 25. Some of them are much higher, some of them are 100 to 200 mil. So we're looking for proven products in market with a strong management team. We're really looking to provide them growth to accelerate, provide them capital to accelerate the growth profile. We find at this space, we could do a lot more diligence on the business and the unit economics, and particularly about what can their return on capital be. So if we provide them capital, what can that return be, rather than just backing a concept. So what this means from a risk profile is it's a far lower risk, but you're getting in at a stage whereby that return is probably that sales is accelerating much faster. So we look at every investment, we're trying to generate a return from every single investment we make. We're not necessarily looking for your 10x's or 100x returns. We're looking for 2 to 3 times return on every single investment that we make. So we find that risk reward profile is much stronger at this stage of investing. You can really do the work to analyze businesses. So that's a really important part of our strategy, is that we do the work and we make sure that our valuation discipline is in line. So we're always looking for that margin of safety. So what we look for is businesses that are founder-led or strong management teams. So we really analyze and spend a lot of time with the management team and the founder. And aligned to that is we're looking for strong alignment. We want them to be heavily incentivized for the success of the company. So their equity exposure is high. They're wedded to the success of the business, and we want to invest alongside them. Proven business model. So we get out in market. We want to see that it's a proven business that could take capital and accelerate. And then we do look for a clear exit. It's sort of a 2-year horizon to an IPO. And we look at it from the point of view of, would this be an attractive IPO that we would want to put more capital in? And if so, then we want to get in earlier. Now, obviously, if it's a good business, IPOs is the first sort of exit, but a lot of them get M&A approaches. In the last few months, a number of our portfolio companies have had M&A sort of approaches, and 1 or 2 of them are strongly considering those. There's one position in PPP2 which we should see come through that's had a takeover approach. Again, that's still a cost because the transaction hasn't materialized. But you know, preference is IPO, but if a strong transaction comes along, then we'll accept those. And then attractive valuation, which you know, it's probably it's our core differentiator. We walk away from a number of companies, even if we like them, if it doesn't have the valuation support. We won't chase up valuations. And importantly, we do use that long-term average in our valuation sort of modeling rather than sort of the last traded price on the ASX or the NASDAQ.
Just on the clear exit, preferably on IPO, what do you do if you find yourself in a situation where a business that originally was private with a view it would list in 2 years, there's a change in strategy, and they're looking to remain private when you do have that 5-year window?
Yeah, so what we try to do with the buckets, so the unlisted expansion and growth are typically those equity positions whereby we do like to get set in those as early as possible. And we look at the businesses from a 2-year horizon to an IPO, but if you're investing in them in the first year, you're giving yourself probably a year and a bit slippage, which is natural. There's always going to be some sort of slippage with 1 or 2 of the companies in terms of timing or something. They may need to operationally just fix a few things. But in our very first conversation, we do talk to them about, are you on that? Is 2 years the horizon that you want to list? So we put that stake in the ground quite early. Now things change, and things do change. And we get to a stage whereby they've veered completely off track. There's quite a large sort of secondary market in a lot of these companies. So we'll actively sort of seek out secondaries and look to sell some of those. In a lot of cases, we've actually bought secondaries of other firms whereby maybe it's veered off their track and we can pick them up at an attractive valuation. But at this stage, we haven't gone down that path, but we do invest alongside other investors that we think could take in some of our secondaries if required. And the other alternatives will sort of work towards an M&A transaction if we think that an IPO is not the path that they want to go down. So it allows a bit of slippage getting invested quite early. In terms of the pre-IPOs, those are usually convertible notes with a maturity date. So the alignment of those maturity dates, it's usually 12 months. At the very long, it's 24 months. But those expire, and usually we'll put pretty strong incentives for the company to list within that time frame. They call it penalize if they don't. It's a sort of crude way of putting it, but it keeps them aligned to what they said they were going to do. So it's either a cash redemption or it's a really strong sort of discount to a valuation. So that helps with the alignment.
You've also got some flexibility in the fund. Let's just say you've got to 4.5 years, and there's a couple of positions left to realise. And you know, if equity market conditions were incredibly soft at that stage, you can extend the fund's life. If it's in the best interest of the fund and investors to make sure conditions are appropriate to realise those last couple of positions. Yeah,
exactly right. So if we get to sort of 4.5 years, it has to be at investors sort of vote. There's a number of alternatives. One, we can extend the life for another 2 years if required in wind down mode. So obviously it would just be the positions that are held. The other option is we could in specie those holdings out to investors. So if, for example, there was a company that we thought was amazing that had plenty more room to grow beyond that, and it was in the best interest for the investors to hold those, we could in specie it out and they would hold them individually. We've got a number of other funds that if we thought it was in the interest of both funds, we could sort of sell the position to another fund. So we do have, we plan it to 5 years. And if you look at PPP1, for example, that's about started 14 months ahead of PPP2. We think that that fund will probably wind up before the 5 years. They've sort of exited a number of positions. So we do plan it quite carefully, and getting set early is a really important part of it, and the opportunity set for this fund and PPP3 sort of allowed us to get set quite early.
And you don't sort of recycle capital, do you? So if the fund initially takes on, say, 20 positions and it's fully invested, as each of those investments are realised, distributions are paid out that are reflective of the sort of proceeds and gains that are made of each of those investments as they're sold.
Yeah, so the unlisted expansion and growth, we're unlikely to recycle any positions there. It'll only happen if there's a sort of takeover within the first year.
Yeah.
And it gives you that opportunity to recycle the principal amount of that. The realized return will always be returned back. Pre-IPOs, we probably look to recycle those positions 1 or 2 times throughout the life of the fund. Those are usually held sort of between 12 and 24 months, and then depends on the valuation on the listed component. So we may recycle some of those, but at the same time, we're encouraging our pre-IPOs to actually stay private a bit longer at the moment. A lot of them are in quite good position, and there's probably no need to list right now, given where the market's at. So we may not recycle as aggressively in that bucket, but at any time we realize a position, that net realized return comes back to investors.
Thanks.
This is the criteria. I won't go through these other than, it's what we sort of spoke about. The one point I will make is we don't do cyclicals. So what we mean by cyclicals is sort of direct agriculture, direct mining on resources, or direct property. We're looking for structural growth companies that could grow through any sort of market cycle. We don't want to take a sort of a position in, for example, a coal mine that could have a spot price quite high today, but in 5 years' time it could be a lot lower. So we look to avoid any cyclical exposures in that way. And so it's purely just about sustainable growth companies. What that tends to lend itself to is technology, consumer-facing companies, in sort of e-commerce businesses. So those are the businesses that it leans towards, and often some healthcare companies that are sort of further along than sort of early stage biotech, but sort of commercialized healthcare companies. We've seen quite a lot of success in that. And we find the reason why I've put this up is that a lot of we'll take ideas from any source anywhere in our network. So some of our best ideas can come from investors in the fund if they sort of got exposure. So if anyone here ever sees a company that they think suits some of these criteria, we would always take a look. And we think one of the most important parts of this strategy is having a wide funnel and seeing as many companies as possible. So therefore, you've got the opportunity to say no as much as often as possible. So you're really picking the eyeballs out of the best ideas possible. So in the last 12 months, we actually saw 700 private companies, and that gives us the ability to really spot what we think are the best positions for the fund. So we'll see over 700, and they come from a vast range of sort of places. They come from brokers, they come from advisors. We've each got our own sort of individual networks that are quite broad, that we get we get ideas from. Some of the other venture funds often see us as a great counterparty to come into those deals and look to invite us into them. So it comes from a broad range, and that's expanding quite rapidly. I think we've positioned ourselves quite strongly in this market, and we're not seeing a huge amount of competition for where we look to play. And I'll touch on that in a few points' time. From that 700, we'd say no to probably 80% quite early on, whether either it's the first meeting or it doesn't quite meet some of the criteria. And we do our fundamental research on about 60. And those 60, we spend a lot of time working through the financials, going to the company, speaking to different management, working on pricing. And then finally, we'll invest in 20 to 35 of those. And the investment, a lot of the time is spent on the deal structure, what sort of terms are in there. We're really focused on sort of that downside protection in every single investment. So whether we've got some options in place, warrants in place, or it's a convertible note structure, we'll take it that our first lens is always that downside protection. We do take board observation rights in a number of the positions. We yet to have ever taken an active board position because we do look to be an independent sort of investor. But that board observation right just gives us the ability to, what we're looking for is the company's taking capital, or they're deploying the capital appropriately, is what we're mainly looking for from our board observations. And then we spend a lot of time working with the companies to proactively seek towards some of these exits or additional investment opportunities through an IPO. This is a little slide of all the investments done so far. So there's some really exciting names in there. Businesses like Indebted is in this fund. That business is disrupting the debt collection process through automated AI. And they've managed to do it in a cost-effective way, which has meant they've been able to go downstream towards sort of industries where typical debt collection has not been able to. So they've been pulled along by all the buy now, pay later firms to do those small debt collections just through an automated fashion. So if you name any single one, Afterpay, Klarna, PayPal, they all use Indebted through an API, and they've been pulled into multiple geographies. So that's an exciting investment for the firm. Spriggy is a consumer finance, so call it child's pocket money. We found the product because a couple of our team members' children use it, and they love the user experience. And we met the founders and were blown away by what they were trying to build. So that's a private business that we've got. And then I'll probably point out one more, Microba. Microba is quite a large position in the fund. That's a gut microbiome testing business. So they've developed a test to sort of, that's world leading in testing for your gut microbiome. And what that's meant is they've been able to collect an enormous amount of data that then can be used in partnerships with other medical researchers or sort of consumer brands to help personalize the gut microbiome or do studies. So that business is currently doing the non-deal roadshow to list. So that'll be the next IPO off the boards. And we got in at a very attractive sort of valuation. So we'll see a nice uplift there, but then we're also going to participate again at the IPO, given, we've seen the business progression over the last sort of 12, 18 months, and they've done an incredible job, and they've signed some incredible partners along the way. So if you ever want any of these positions to jump out to you, I'm happy to take any questions on those as well. But
just on Red Earth, Ryan, I read about that in the paper. That's a pretty new position in the portfolio down the bottom left there. Do you want to tell us a bit about Red Earth? It seems they're doing some interesting stuff.
Yeah, so we've been sort of positioning some of our more recent positions to call it your more industrial businesses that are quite high cash generative, and that have often been forgotten by some of your private investors. Red Earth is that they're in that whole clean energy space, which is obviously booming, and it's a highly cash generative company. They're an alternative sort of energy storage company, and they did a pre-IPO a few months ago. So it's one of our more recent positions. It's a smallish position given it was quite overly highly subscribed for. So but we'll look to build upon that position quite aggressively, either through another private round or at the IPO. But it fits exactly what we're looking for, that it's a cash generative company at a good valuation, and it's one of the more recent pre-IPOs. Another one in that space, I'm just trying to find on here, is Exchange or Expansive.
Exchange, bottom right, I think it is.
Bottom right. Yep, there we go. So that's actually our biggest pre-IPO position. There was a bit of press in them the other day in the AFR. We participated in the very first convertible note and maybe it's with some of our pre-IPOs, when we do a convertible note, we often have a discount to the next raise. So call it a 20 or 25% discount to the next funding round, with a coupon or an interest rate that runs through the investment. Often we take that coupon in shares. But we also look for a cap. So what that means is you get in your investment is subject to the lesser of the discount or the cap. And our investment in exchange there was a really attractive cap in place. So what that means is we'll probably, when this converts, it'll probably convert at a 50 to 60% discount rather than your normal sort of 20%. Given the way the business has performed, that cap was sort of the low 100 millions, whereas the last sort of round's been spoken about in 1 to 2 billion sort of valuation. So you can see our cap will kick in, and they're again in that sort of marketplace for clean energy. So quite a thematic there.
So why do you have that in the fund, right? Sorry.
That one is it was our biggest pre-IPO. It's come down with Animoca going up, but at the time of investing, that was a 5 to 6% weight. So it'll still be around the 4% mark.
Mm-hmm.
But again, those convertible notes are always held at cost, given they're not actually or equity position. But there's an equity-like exposure when you've got a cap in place. So I think we've got that equity exposure through exchange. So I'm happy to share this after, so people can sort of look at some of the positions as well.
Thanks. This
is a dashboard of all the investments we've done, and sort of gives you a good feel of how we split our investments. So we've done this is since inception, so not just PPP2, but across all the strategies. But
Ryan, maybe just before that, just if you go back to the previous pages, one that jumped out there, I think you're worthwhile just talking about something that hasn't gone right, and I know it's before pay on there.
Yes. Yep.
I just say it because I saw it in the press last week on IPO. I think it was down 45% or something.
Oh, that's been shocking. For PPP2 investors, they dodged it. It's not an investment in PPP2. It was a 0.5% position for PPP3, and we invested in the pre-IPO, but didn't follow into the IPO. At the pre-IPO, the founder was still on board, and the business is growing quite strongly since that investment. There was a lot of management changes, so it was a fairly small position. But look, we don't hide from any investments. There's Before Pay and Nutricare, which is on here, are the two positions that haven't been ideal. Nutricare over here, that's a Fund 1 investment which we've written down to nil. The business is still going, but we got concerned with that it was in trouble, so we wrote it down to nil. But it's important that not every position is going to work. You learn from those, but position sizing has been quite important for us. So Before Pay, fortunately, didn't really hurt very much, given and was a 0.5% weight in the fund. And look, if the business continued to perform and it was on track, we probably would have increased the weight at the IPO. So we usually start our investments smaller and look to build as they sort of continue to perform. But you're right, that one hasn't been great, and is sort of in line with the whole sector, sort of dropping off quite materially.
Thanks.
So this is some of the exposure. So we've done actually 50-50 pre-IPOs and unlisted growth. What we found is, if you think about the market, when we first started this, there was probably only one other pre-IPO investor. There's been a few more that have entered into the space. It hasn't impacted our investments. We're still probably seen as the partner of choice, and our brand's really held us in good stead. But the unlisted expansion and growth, we're finding almost no competition at all in that space. You've got your sort of early investors that are targeting those very early returns, and you've got your listed investors. But there's a bit of a gap in unlisted expansion and growth, whereby there's only one or two other firms that have got a very different structure to what we do that participate in this. So we're finding ourselves, we've got a really good competitive advantage there. And whilst those positions at the unit price level don't show until a little bit later, we're finding sort of call it golden nuggets in there that other typical pre-IPO investors aren't getting exposure to. So we'll continue to sort of hone in on that part of the market as we find those opportunities. And then I'll just highlight the one domestic and offshore. We do have the ability to do OECD based investments if we've got a linkage back to the company and we know the management team. And we've actually got a partner that's based in New York that helps source some deals for us if they're appropriate and they've got a track towards an ASX listing. So we have actually done a few offshore companies since inception. So we've done 14, so 18%, but still heavily weighted towards Australia. But every now and then you do find an OECD-based company that's that fits this mandate quite well. I think another question's just popped up there, Anthony.
Are you sector agnostic, or are your management team skilled in certain sectors? Probably reflects back to your cyclical question.
Yeah, so we're fairly sector agnostic, other than we don't do cyclicals, but we do. It's funny, if you look at all these investments, they're all pretty easy businesses to understand. So we look for product-led businesses whereby we can actually analyze the product quite well, and we're really focused on unit economics of the business. So things like net revenue retention. So can they grow within their install base? What's the lifetime value to payback? We look for businesses that they've got a low customer acquisition cost that can grow quite quickly. So they tend to be technology, consumer facing, and then industrial businesses is what we gear towards with every now and then a strong healthcare company that we can understand quite clearly. And this is actually the perfect place for that sector. So this is our split. So we've done it. You can see fintech, healthcare, SaaS, which is call it technology, e-commerce, services, and others. It's kind of like your industrials. Animoca Brands, for example, fits in services, and others. It's a gaming company. But businesses that we can touch and feel and use ourselves as users, and we can speak to customers and we can get customer validation is where we'll go towards. So, you know, your deep AI sort of technology companies that we probably don't understand, we'll look to avoid those. We want to be able to speak to customers and understand their businesses, but at the same time, there's a good mix of sectors here, which means we're not wedded to one sort of space, which gives again that sort of portfolio diversity. I'm happy to pause there. I've got a couple of case studies of a few businesses that are in the fund. This is one that I'm particularly excited about. It's a business called With You, With Me. It's an HR technology and SaaS company, but the origins of the business came from the founders were ex-military or veterans, and they came out of the army and weren't able to find a job because they didn't have any sort of skill sets that were applicable to the workforce. So what the founders did, which is Tom Moore, he basically set up a business to help veterans get back into the workforce through training, and it was a bit of a recruitment business that connected veterans to the workforce. So we met Tom sort of 3-4 years ago and thought he'd had an interesting business. By the time we invested, we spoke to Tom 12 months earlier and said to him, we love what you're doing, but from our point of view, we don't necessarily love recruitment businesses for this style of fund, given that they can be quite, the working capital is quite negative, and you know, you can get high revenue, but the cash generation isn't strong. But we thought he had the opportunity to develop a SaaS-based business model through content and then selling that content and trading towards enterprises. And so in the space of 6 months, the business developed that technology platform, and it already got, you know, really strong traction in the workforce. So we led their Series B equity round, and we did it through 3 tranches with different milestones for the company to hit. And then we kept adding capital and brought some counterparties into that deal that we thought could be value add to the company. So sort of ex-Seek and ex-LinkedIn high executives and CEOs of those businesses came in alongside us, and they really guided the company quite strongly. So pleasingly, we just settled tranche 3 because the business exceeded the milestones that we put in front of them. So the business is now on track to do 52 million revenue from the time in which we invested. That was 10. So 5-folded, and has expanded into the UK, US, Canada, and most importantly is added on like amazing talent into the business. So, you know, people from Canva and Qualtrics have all joined the business. So now you're getting this real influx of talent and a good product and a fast growing business. So that's one company that we're particularly excited with. They're looking to potentially list within the next 12 months, and we'll see a material uplift from our holding valuation. Our first tranche was at 40 mil, with sort of now SaaS economics. So you can see the uplift potential there is quite meaningful. And then another sort of different business is a business called Locator, which is an unlisted expansion and growth business in PPP2. So what Locator does is, if we think about, they're a GPS replacement technology company. They describe GPS as like Swiss cheese. It works, but there's holes everywhere. It doesn't work in a lot of places. They basically go and fill those holes. So they've spent 20 odd years developing the technology. Have got over 170 patents, and have now won material contracts with the US Air Force, Caterpillar, a number of cranes around the world for ports, and they really play into the whole automation space. So if you want to automate your port, you'll put in the Locator devices that then help you sort of navigate the machinery in an automated fashion. So we provided them capital on the back of their Caterpillar win. Caterpillar is going to put the Locator technology as part of their machinery for the mining sector. So really unique sort of business model. We invested sort of in the heart of COVID there, and they had another term sheet from an offshore provider at double the valuation. But the founder's Australian and wanted to work with us. He thinks we can be a good counterparty that can help them transition from the private market to the public market. So sort of accepted our terms, even though it was half the value of what the offshore sort of providers were willing to offer. And more recently, they've just tendered for a whole Europe contract. So if that comes off, that's going to be a really exciting contract and instantly makes the business very big. So if they win that contract, we'll be providing an update to everyone. But all things are quite positive on that. Again, it's an investment that's at cost, but it's just important to highlight that operationally, some of these companies are really excelling. And with you, with me, and Locator.
When's Locator looking to list, do you think, that next round?
We think it's between 12 and 18 months.
Okay.
Both Locator and with you, with me are probably two of the 5 biggest positions in the fund. So
sure.
Both doing really well, which is exciting.
All right.
I'll pause there if there's any further questions.
Do you see, I'll ask one. I mean, do you see any, I mean, you mentioned before that you're pretty comfortable there, all the underlying positions in P2P2 are performing and a few are ahead of expectations. Are there any risks you see at all on the horizon outside of the 5% allocation of listed space? Is there any concerns at all in the current portfolio?
One thing we're thinking quite a lot about at the moment is the timing of some of these businesses potentially listing. We've got a number of positions that we're thinking of listing this quarter or next, and I think we may see some slippage in terms of listing events. Would be one that's more a timing risk with some of those companies, which means from a fund return point of view, it sort of, we may get a little bit of a gap and then it'll pick up again. Operationally, we're comfortable with all the positions in the fund. And from a valuation point of view, it was difficult to walk away from a lot, but we're comfortable with that. But it's probably the timing in terms of the exit events, which may get pushed out slightly. But at this point of the fund, we're probably encouraging them to just stay private a little bit longer. We've got that flexibility. The fund's still got plenty of time to go. So that would be the key risk.
An example of that, right? You've gone in December 2020, you just mentioned 12 to 18 months. So that could be a 3-year with 3 years pathway to listing.
Yeah, Locator is one of those, and Locator is slightly different because if they win this contract, they'll probably go towards a NASDAQ listing. The size of the business will be really material.
It's a quality problem.
But other ones, it's more some of the pre-IPOs. We'll see Microba come off, but that's sort of its own little beast. It's kind of uncorrelated to everything, and they've got plenty of news flow, but other businesses that may just hold off a bit longer. The listed market's been volatile and working in that, it's hard to get a look into the IPO. On that point, when the downturn we think is really positive for us, given we sort of aren't that exposed to the listed market, but it gives us the opportunity to sort of reset expectations for these businesses. A lot of them are sort of convertible notes which aren't set to a sort of equity value, so it gives us an opportunity to reset the next valuation, put more capital to work, and so we'll look to keep investing further at these good valuations and then getting the IPO prices at the appropriate price so we can put further capital in. So we're quite pleased with what's happened. Actually, it felt like it was needed.
Right.
Pause there if there's any others, Anthony. Otherwise, I'll stop share.
Yeah, no, I think so. It's a great summary from the strategy to how it's evolving over time. We're starting to obviously see some of those realisation events come through. I think we alluded to in the initial invite that the next sort of 6 to 12 months, touch wood should deliver some pretty strong returns to investors, which is great. And we appreciate all the work of yours and your team, Ryan, in delivering those returns. So I don't think there's any other questions from the audience. As I said at the start of this webinar, if anyone did have any questions that come out of today's presentation, you can email me directly and we'll get those through to Ryan. But look, thanks again for your time, and we'll probably dial you back in maybe 6 months' time for a bit of an update and see how things are going then. Yeah,
that's brilliant. And again, thanks for all the support. We really appreciate it.
Great. Well, thank you everybody again for attending today. I know everybody's busy, and we appreciate you dialing in, and we'll be sending out a recording of the webinar as well. So thanks again for your time, Ryan. Thanks again for everyone dialing in. Much appreciated.
Brilliant. Thank you.